Most first-time buyers think the danger ends once the LOI is signed. But the truth? That's when the real risk begins. One missed clause, one bad structure, and your dream acquisition can turn into a financial nightmare. I've seen deals collapse in the final week, all because the buyer didn't know what to protect. In this episode, we're breaking down how to protect yourself before you close, the clauses that matter, the landmines that kill deals, and how smart buyers structure terms that keep them safe and get deals done. If you're buying your first business, watch this before signing anything.
When you are doing the LOI, you want to have very general language, normalized level of net working capital. Sometimes brokers will push you and say like, oh, I want to say working capital is X. They want you to put a number on it. Problem is you just don't know if that's true. I would say though, that even when you're doing a fully seller finance deal, you still need to have a plan for working capital. Because even if you only are doing seller financing, if you don't have the money to pay payroll in like the first month because there's no stuff coming in, then like, that's still a problem. Well, my background is, so I graduated Harvard Law School and I started work in private equity mergers and acquisitions on Wall Street. I did that for a number of years. And then after about 4 years on Wall Street, I left and I honestly didn't know what I was going to do. I started freelancing I just knew I didn't want to be in the big law environment anymore. And then lo and behold, there was this entire ecosystem of M&A happening at just a much smaller level. And so I just took all the skills I had from Wall Street and just applied them all to M&A on this scale, and then just started doing more and more of it. I was very fortunate to get connected with the Acquiring Minds podcast and do their legal webinars. And anyway, so it ended up being great. So now that's all I do full time. I have another partner who also works with me, and we have like 30 active M&A deals at the moment, to give you a sense. So
Oh, wow.
we're very active in the market, and we really have a sense of sort of what's normal, what's not normal, all this good stuff.
Okay, well, let's start there. What's normal and what's not normal?
Well, it's always like what the issue is that you're concerned about. So, what I'm happy to do, and I don't want to jump ahead too much to the presentation, but basically what I usually do when I'm talking to people that are at the beginning of the process is give them like tips and tricks of things we see people do that they really shouldn't do
Okay.
before a lawyer gets involved. Because at some point you're going to hire a lawyer as part of this process. And then they'll be your Sherpa to get you, to the top of Mount Everest. But we're here to kind of get you to base camp so that you don't make mistakes that'll end up hurting you like along the way.
Okay. Well, if you want to start the presentation and then we'll open it up for questions.
Okay, great. Yeah. So happy, by the way, if anybody has any chats, any other questions, I like to have back and forth. My general approach is to maybe have 20 minutes of more lecture time, and then hopefully we get questions. And if not, I'll punish you with more lecture time from an attorney. So just keep that in mind. So anyway, my name is Bill Barlow. I'm from the law firm Barlow and Williams. We're sort of unique. We do a lot of work in this space. We do work on a flat fee with milestone-based pricing. And just so that I'm aware, Jay, is this more people that are more looking at self-funded search, or are there any traditional searchers, independent sponsors, or is it more?
Mostly self-funded.
Okay, self-funded search, I assume using SBA financing is kind of the
Uh,
bread and butter here.
yes, correct.
Okay, great. All right, so maybe what I can do is just kind of give you some like high level thoughts of things that people, especially searchers, do that can kind of trip them up in the initial parts of the process.
Okay.
So one of the questions we get often is, do I need to set up a legal entity? And the answer is it's fine to set up a legal entity. There's no real downside to it, but it's not always necessary if you're doing a self-funded search. And sometimes if you don't know what state you're going to be in, you end up like setting up a legal entity where you are now, and then you set up a different legal entity in the state where you end up buying the company. And that could be extra expense, etc. So don't feel too much pressure. It's a good idea, but it's not really strictly speaking necessary. Um, Usually you're just going to default to an LLC. Some people might have heard of QSBS, tax-free exits, all that stuff. I would say, I would caution. I'm not saying we have done deals where people have set up a C corporation to try and get QSBS. Most searchers, for most of the deals that you're looking at, an LLC is going to be the better option. Um, so my default, if you don't know, my default is to do an LLC. If you're interested in exploring other options, you can always talk to an attorney, but usually it's very specific to a deal. It's very specific types of deals that really benefit from that. So normally the rule of thumb is an LLC. Um, the other questions we get is like, what about signing NDAs? You're going to sign a lot of NDAs. Honestly, almost all the time, it's fine to sign an NDA. And it's obviously way too expensive to get a lawyer involved. The only time we've seen clients get in trouble with NDAs is once, I should say, there was a site that basically said that if you sign this NDA, you have to pay 1% of the purchase price to whoever is providing this information. And our client just signed it, not really, just like, oh, NDA, click the button, right? And didn't realize that fact. And, we had to go through a process to negotiate to basically have him not pay that. But it was like an arduous, stressful process. And obviously, so if you see anything like that, like don't sign it. But, you know, again, 99% of the time, it's fine. The other time we see buyers get into trouble is when they sign broker provided forms. And I'll say off the top of the bat, broker provided forms can be okay and can be completely horrible and one-sided. And you don't know which one it is unless you get a lawyer involved, to tell you like, okay, this is actually fine, or like, oh my gosh, you're actually signing a purchase agreement and you're putting down a deposit for like $50,000 that's non-refundable. Like that's terrible. Never do that. So never sign a broker provided form without talking to an attorney and kind of consulting with them first.
Like, so you mean like LOI? So use your own LOI templates. Don't use the broker's template. Okay, got it.
Exactly. Like if the broker is saying you have to use your template, talk to an attorney before
Yeah.
you accept that. And in terms of LOI templates, there's a lot of good examples online. We have one on our website. If you just barlowandwilliams.law, you can just ask us for it. We'll give you the template. And it also specifies like a bunch of information there. So there are other templates out there, but do use ones from attorneys. Don't just assume that ChatGPT is going to be good enough, because ChatGPT often doesn't it will make mistakes and often do things that are not appropriate for your type of transaction. So, just keep that in mind. Just use a template from an attorney. It's just easier. And then in terms of biggest mistakes we see people make, structurally speaking, usually it's one, they don't specify the type of deal. So the default is you want to be purchasing assets and not stock. Sometimes you have to purchase stock because there's legacy contracts, there's licenses, there's reasons for it, but your default should be assets. Another thing is you're not clearly specifying how the purchase price works. So you want to say like, I'm buying this company for $1 million, of which $100,000 is a seller note and $900,000 is in cash. You want to clearly specify it so the seller knows exactly what you're saying. The other thing we make a mistake is sometimes people will offer things that aren't allowed by the SBA. So they'll say, I'm going to do an earnout. And you can do what's called a forgivable seller note that says something like, hey, if revenues do not continue to hit the same numbers they were before, then I'm not going to pay you as much of your seller note. That's allowed. But a lot of times you'll say something like, well, I'll pay you 10% of revenue above $1 million or something like that. And that's not allowed under SBA rules. So again, templates like ours will actually explain the rules and be updated for the new rules so that you can do that. But that's a common mistake people find. Or people want to roll equity, and under the new rules, it's really hard to roll equity unless the seller is interested in personally guaranteeing the note. you can't have the seller roll equity. So, keep those in mind. The other thing is generally you want to say in the LOI, I'm buying this business for like $1 million because it's this multiple of EBITDA. It's a 4x multiple of whatever $250,000 EBITDA, right? That way, if the quality of earnings comes back and it's actually the EBITDA is lower, then then you can lower it and say like, hey, it's a lower EBITDA, I'm giving a lower purchase price. You also should address working capital. So you should assume that working capital is coming with the business. Not all sellers understand it that way. They think, hey, I did the work, I sent out the invoice, there's an accounts receivable, that money belongs to me, right? But if you give them all that, then you're going to have a huge lean period for the first 30, 60, 90 days as money is like not coming in because the seller kept all the invoices. So that's especially important, by the way, if anybody's looking to buy a business that's like project-based. So I'm doing like construction, I'm doing things for 3 months or whatever. Like you need to know how those projects are going to be handled as well, as part of this process. Um, and yeah, I mean, there's a couple other things we could talk about, like exclusivity is typically you should just say 90 days and they'll negotiate it down to 60 sometimes. Usually it takes about 90 days for an SBA deal to close. We've seen some that happen quicker, but certain banks are slower than others. So just keep in mind this process always takes longer than people think it does. Those are kind of my main points on sort of the initial structuring. And my next talk, I want to pause here because the next thing I'll talk about is probably like some red flags, like things that end up killing the deal that you should really know about. But maybe pause here if there are any questions on kind of structuring or anything else you want to say on kind of the initial part.
Yeah, anyone has any questions?
I got a question.
Sure.
So in terms of working capital, one thing that I've encountered is that there's kind of a different approach by the sellers, depending on whether you're kind of a lower middle market, like, say 2 million and under versus kind of the more expensive deals. As you get up to kind of the 4 or 5 million, it sounds like including working capital from the seller is more common versus like, the asset deals under 2 million seems like it's more common that working capital is just something you gotta work out on your loan with the SBA lender, and it's not something they're going to pass along to you. I've encountered that several times in the discussions, but I'm just wondering, is that common or is that just brokers trying to protect their seller?
Yeah, trying to protect themselves. I mean, I think, in general, you're right. The lower it is, the less likely you're going to be to include to have a working capital adjustment. I do still see it being much more common than not in the deals we do in the lower market, like SBA deals, to have working capital included, right? To say you have to come with a certain amount of working capital. So I think mostly that's brokers just kind of blowing smoke at you. But
well, my point was that the lenders are telling me I have to have the working capital, and they're just rolling it into their loan. So they're just saying, hey, you're buying for $1 million, we're going to put 150,000 of working capital on top of that, plus closing costs, blah blah blah. Your loan is now X.
Yes, but you do both. So you do, because the rule of thumb is you want as much working capital as you can, because that is one of the prime ways people end up losing the business. So what you do is you both say to the seller, I need a normalized working capital at closing. And you go to your lender and say, I need to have this working capital line at closing as well. Because that line, it's usually a line that you have, you don't draw it at closing. So you don't want to basically be in a position that in the first month, no money is coming in. So you're having to draw on that line, right? Ideally, money is coming in because you bought the working capital. And then you only are drawing on the line as needed for, occasional, you'll still have some space in between or whatever. Does that kind of make sense?
It does, yeah.
Yeah. And a lot of times brokers don't do it, but the golden rule of thumb is take as much working capital as the bank will allow you to take. So yeah.
And it's a negotiation. Depends on what's going on with that with that seller, their how many offers they have, who's asking for what, and that's the competitive environment. That's what kind of sets the tone of these things.
Yeah. And there
That's
are
great.
certain
And
businesses that don't really have that much AR, right? Like they just
Yeah.
sell things as they come in and blah, blah, blah. And there are other businesses for which they have a lot of AR and you actually have to negotiate it.
What
and
what
is
have you?
that something that can happen after LOI? Sorry, just, you know, if you stayed in the LOI, we're expecting to have a certain, a normal amount of working capital, blah, blah, blah. Again, very generic language at that point. But then as you're doing your due diligence, QV and all that, is it common sometimes to then get more specific about how much working capital is coming from the seller, how much is coming from your loan, blah, blah, blah?
Yeah. And that is actually a good point. When you are doing the LOI, you want to have very general language, right? Normalized level of net working capital. Sometimes brokers will push you and say like, oh, I want to say working capital is X. They want you to put a number on it. Problem is you just don't know if that's true. Like you haven't actually done the financial diligence to confirm what that QOE is. So you're right. After you do that and you go through with your advisors, you have a conversation about what actually is normal. Because sometimes, honestly, with some of these businesses, some sellers just love leaving a bunch of cash like in their business. And sometimes they're like have pretty atrocious account receivable collection cycles. And they're like, hey, I don't want to give you all this just because I've been lazy. And so it is a negotiation each time. So,
Dora, any other question?
Yeah, Bill, how would you handle this in a situation where it's heavily seller financed and no bank involved?
well, when there's no bank involved, then you have a lot more flexibility. Um, and you know, when it's heavy seller finance, honestly, like the seller is probably giving you good terms, and that's usually a special situation, like why the seller is willing to basically offer that to you. So you know, I would say though that even when you're doing a fully seller finance deal, you still need to have a plan for working capital, right? Because even if you only are doing seller financing, if you don't have the money to pay payroll in like the first month because there's no stuff coming in, then like that's still a problem. So,
Yeah,
but
the working capital needs are going to be there regardless of what the financing of the deal is. So it's just a matter of like negotiation. If you're getting a really good deal, then you may try to figure out how to finance. You add whatever capital you're going to bring in to working capital, add that as to the price of the business. If you're, but yeah, it's just you're always going to need working capital.
yeah. We've seen deals that are all seller finance that actually ran into real trouble because of working capital stuff. So
Yeah, and the seller financing terms can be shorter, so the amortization is shorter, and you end up paying more. Paying more cash flow into that seller financing, so it gets squeezed much harder than you would do in 10-year amortization. A longer term amortization. So yeah, I could see that.
Thanks.
Can I quick chime in? Bill, do you tend to try to keep that? I think you kind of spoke to it a little earlier, but more vague so that you can get the deal done, the LOI signed, and then kind of get into those gory details. I think you're kicking the can down the road
yeah.
for the agreement of sale, but I'm going back and forth right now about to submit an LOI, but I'm like, the less is more, I feel like, from my standpoint, because I feel like I'm getting a good deal. But then I don't want to kick down all these problems down the road.
So the seller has the greatest leverage at the LOI stage. So that's why it's best for you as the buyer to keep things intentionally, not intentionally, but you want to keep things vague. You want the working capital number. You don't know what that number is yet. You just say it's normalized, right? Now, certain things you don't want to keep vague. You don't want to keep vague like what your purchase price is, how it's broken out, all that other stuff. Like you do want that to be clear so that you have a deal. And if there's any material points, you don't want to have an LOI that's so vague that you basically get after you pay a bunch of money for QOE, you get to the purchase agreement stage and you don't actually have a deal, right? You don't want that. But details like that, sometimes like indemnification provisions, other things, in general, you can leave that. Non-competes, you could just say a standard non-compete. It really should be 5 years, but you don't necessarily have to say that in the LOI.
So interesting because I'm just being advised not to have it that way. So, I mean, I like your rhetoric way better. So,
Yeah. No, it's interesting. Some people are like, oh, you have to do it, but the answer is no. Like you want it to be simple, and this is the point where you have the least leverage. So you should want to negotiate the least at the LOI stage, kind of the least necessary.
So you're okay with all the indemnifications, just keeping that out?
Yeah,
Okay. All right.
yeah, keep it out. The only time where if they put it back in and they say like, you could just say something like there'll be standard indemnifications provisions, and that's it. Don't need to say anything more than that.
Okay. I like it.
So
What have you seen on deals that have inventory? So we're seeing a lot more distributors, part distributors, and equipment distributors, or what have you
yeah.
in terms of inventory? What is a typical like acceptable standard, if you will, term on that? Which is going to
Yeah.
work. It's very similar to working capital, but how do you kind of what's the language in the
Yeah,
LOI?
so it depends. So, a lot of businesses just have kind of normal levels of you just say like you're including normalized levels of inventory. Sometimes they have like a ton of inventory, and then you might buy some inventory on consignment, which basically means that like I will only pay for it as I am able to sell it, because I don't know if I need 1 million widgets. Maybe I can only sell 100,000 widgets, and I don't want to pay for 1 million widgets.
Yeah.
Um, if you have things like distributors, you're talking about equipment for like things like tractors and all that
Or
stuff.
or just parts. Let's just say like parts distributors.
Okay. Yeah, I mean, realistically, you need to have enough inventory that's in the normal course of business, and that needs to just be included,
Okay.
because that should be your default. Right now, if they come back to you and you say, I I thought tariffs were coming, and so I bought way more, I have way more inventory than I need to, I want to get credit for that. You can have that discussion.
Yeah.
Like the default should be that they probably have a normal level of inventory, and that needs to be included.
Okay. So in the language will be normal level of inventory included in the sale. Any old inventory or extra inventory will be bought at consignment, if you will.
Yeah, you could do. I mean, I wouldn't even deal with that second one, because then you're already setting yourself up for a fight.
Ah, got it.
Like,
Got it.
oh, all this stuff is in consignment. I would just say this is included, and
Okay.
then let them bring it up if they think they have excess.
Makes sense. Okay. Yeah, because that comes up front. Some people think that inventory is separate from the business, and some, there's all kinds of uh, misconceptions. And brokers don't do a really good job educating yeah, especially if they're not specialized in that industry.
Exactly.
Okay.
Um,
Red
and
flags.
yeah, we can move on to sort of red flags. So, some of these are red flags with the business. Some of these are just red flags in the deal. And what I want to do here is kind of flag certain things that you should be looking out for. Basically, sometimes even before you're doing quality of earnings, because it can sink it. So I'm going to talk about one that sinks, as we've seen sink a couple of deals. It's leases. This is often not an issue. In fact, in 90% of cases, it's not an issue. But in like 10% of cases, you have multiple locations and it's kind of a mess to coordinate with all the landlords, and you get a stubborn landlord that's like, I'm not going to sign up for the SBA terms, and like the deal just dies. It just dies because of bad landlords. So that's one that you should get in front of. You should also get in front of if there are any license requirements. So like you're buying a business and it's an electrician business, and there's an electrician's license, and you don't have an electrician's license, and none of the employees have an electrician's license. Like, you probably can't do the deal, right? Somebody has to have the electrician's license to do the deal. And so, and post closing, because usually the seller owns the license, but as soon as the seller is, out of the business, the business won't have the license anymore. And there's not really a great creative workaround. There used to be more space for that, but with all the stuff about seller roles, it's becoming harder to do. So just keep that in mind.
Yeah, and we have a situation now where the lender, even though the seller is staying on and doing seller financing and wants to keep the license in the business, the bank will not allow him to keep the license in the business. So they're pushing the buyer to go find it somewhere else.
Oh, interesting. Is the seller even retaining equity?
He's not retaining equity, but he's seller financing.
Okay, well, yeah, unless they're retaining equity, the bank is going to require them to have somebody else. Even if they're doing seller
Okay,
financing, if the seller were to retain equity, they would have to guarantee the loan, and then it would probably be okay with the
correct,
bank, but it
correct.
probably wouldn't be okay with the seller. So,
Yeah, but some banks are okay with it actually, and then just this one bank is not.
well, yeah, I mean, every bank can have their own sort of rule.
Yes. Yeah.
We find most banks want, because if you're buying using the SBA, the seller can't be an employee and has to be out after 12 months. Most banks want some sort of plan for a non-seller to be involved.
Yeah. Okay.
Um, Other things that could be red flags, let's say that there's multiple owners and not every owner is on board. We've seen that happen. There might even be ongoing litigation. Like we've seen that happen between owners. So you want to know about that. Again, usually not an issue, but when it's an issue, it's a huge issue. Another thing is key employees. So, you know, you might have this entire business that's kind of structured around like a sales rep who is doing lots of sales, but can you keep that guy? Right? Are they gonna jump ship? When are you going to have the conversation with them? Because the seller usually doesn't want you to talk to key employees until like the day of closing. But you have to, especially if they're key employees, you want to talk to them as early as possible. So that's always a dance. And is there a key employee? And is that we've seen times where the key employee risk is just too high. Another thing, very common, customer concentration, right? 50% of the business is just with one customer. That's difficult. So, is it always a deal killer? Not always. We're closing a deal this week where there's a 50% customer concentration. So it can happen. In that deal, they got comfortable with it by having a 50% seller note that got forgiven if revenue targets weren't hit. So basically, if that key customer leaves, like half of the purchase price effectively goes away. So, but again, these are things you have to know because if this only comes out after you've paid $15,000 for quality of earnings or $20,000 or whatever it is, then like you don't want to do that. Or if you're an independent sponsor, it's going to be even more. You just want to get those things out of the way. Supplier agreements, again, if you have a key distributor, sometimes if you're a franchise, you're buying a franchise, you want to review that franchise agreement as quickly as possible. And then if you have like a key distributor, like some supplier has, you're basically just reselling most of their products, you need to nail down that relationship. Those are kind of the main things. There's also sometimes IP if there are patents that are necessary. If you're buying a software business, what's their code like? Do they actually own the code? Is there, do they have the proper agreements, that type of stuff? And then you want to get a sense of what their inventory is like. Because sometimes, a very common issue is sometimes they want to exclude their personal truck or something like that. Again, that's usually not a red flag issue, but you just want to make sure that you're clear about, what you're getting, what they're getting. Anyway, so those are kind of the main things. The other red flag I'll just raise is that non-competes, if your seller is really kind of saying, hey, you said 5-year non-compete, I want it to be a 3-year non-compete. And you're like, you said you're retiring. Why are you fighting me on this? It's very normal for them to fight the scope of the non-compete. They're like, hey, you made this really broad. I want it to be narrow because I don't want to narrow my option. That's fine. But if they're fighting you on the time of it, that's always weird to me. That makes me nervous. Because there's no real reason to fight the time unless you have some plan to get back in the
Or
business.
family members would not compete as well, like the son or the
Yeah.
spouse or whatever.
I mean, that's super tricky because, technically you can't really force them. I mean, you could put language in there, but you
Yeah.
force them to not have their son do this.
Yeah.
Sometimes you like have them like the son become an owner, and then you're having a non-compete, or like they're part of, there are other ways to do it, but like that's always a tricky one. That's very tricky.
Yeah. Yeah. Well, can you enforce a non-solicit?
So you have two things: non-competes,
Yeah.
non-solicits.
Yeah.
Non-solicit basically says you can't start, basically trying to hire away our customers or
Yeah.
employees.
Correct.
Those are pretty enforceable.
Okay.
Non-compete says you can't do this type of business.
Yeah. It's harder to enforce than
Yeah.
than non-solicit. Yeah.
Well, especially for employees.
Yeah.
Against the person who's selling their business, even in places like California, non-competes are more enforceable. But if you're talking about like an employee non-compete, yeah, there are some states where it's like straight up, like you just can't do it.
Yeah. Yeah.
So,
Doran, go ahead.
Yeah, what strategies have you seen people use to address the key employee risk?
the first thing is to identify who the key employees are. And then the second thing is, they have to be on board with the trend with you going forward. So oftentimes you'll have a stay bonus. So you might say like, hey, I will give you extra money if you stay here for 6 months, 12 months or whatever. And then you want them to sign a non-compete and a non-solicit. The problem is sometimes you have key employees that the seller says, hey, this key employee, they've been in this company for 15 years. If you walk up to them and give them a non-compete agreement, they're gonna like balk, and they're gonna be like, who's this guy coming in, making me sign all this new paperwork? So it's a little delicate. Non-solicit is probably even more important and usually less objectionable. Like, hey, don't poach our employees, don't poach our customers, even more importantly. So usually you can compromise and get them to sign an agreement with a non-solicit. But it's a tricky dance. It's a tricky dance.
So what are your thoughts on reps and warranties?
It's good to have.
Now, what have you seen like that? Most buyers don't spend that much time. They only look at them at the end. They
Yeah.
don't think about them ahead of time. What would you like, let's say when the clients come to you, what are the things that you would love for them to know before coming to you? So at the end, you're not bogged down with a lot of the language, reps and warranties, covenants, all the good stuff that comes at the end.
Well, what I'd say is for most of those things, the good news is that a good attorney will just have really good, solid language to cover that. And oftentimes I don't need to go over that with my buyers because I just, I have it. And the only time sometimes it comes up, they say, oh, the seller says, I don't understand why there's, all these pages of representations and warranties.
Yeah.
And what I say to that is it's kind of like a building code. Like these things have been written in blood. Like the reason why, we have warranties for all these things is because there were deals where like that wasn't true and it went wrong and it caused a problem for the buyer.
Yeah.
So it can be a little intimidating, but you just know that, look, it's a 40-page agreement. And I know that some sellers are like, you should be able to do this on a 5-page agreement, but you just got to trust your attorney is creating, the necessary documents. And luckily you can just trust them on that. The one issue where we'll often get client input on is what's called indemnification caps. So basically the market practice is that if the seller breaches those representations and warranties, there's a limit to how much you can take from the seller. And that is a heavily negotiated point, unless it's like something like fraud or like they don't own the assets or that type of stuff. So usually there's a limit to that. And you have to understand that, even if they breach some of these representations, you often don't have like unlimited recourse.
Okay. How about like the timeline for that indemnification? So do you get sellers pushing back on those? So let's go back. What are the things that the sellers push on?
Yeah. So the sellers, well, assuming the seller has a competent attorney,
Yeah,
because if they don't, sometimes they'll push back on crazy stuff.
everything. Yeah.
But usually they'll push back on what are the limits, what are the time limits. So usually we say you have 24 months to make a non-fundamental claim. Usually that gets negotiated down to 12 months if they have a competent attorney. But usually you'll honestly, usually you'll be able to tell pretty quickly if there's a problem in the business. They will often, with the non-compete, they'll want to get more specific and make sure that sometimes they'll have like carve outs if they have like another business going on. They'll also want to disclose things. So they'll have like disclosure schedules. They might say like, well, I do have a litigation. There's this lawsuit that happened 4 years ago by this crazy person that, is not completely resolved yet. And like most of the time, that's just a matter of disclosing things properly. And, working capital obviously is always just perpetually an issue. And sometimes with representations and warranties, some of the language gets really specific, but I'm probably already putting you guys to sleep as it is.
No,
So.
no, it's good. No, this is good. We talk about these things quite a bit. So when we love when we get an attorney to go into the nitty gritty. So you can go as deep as you want on this because it's fascinating. Because we don't get to talk to a lot of attorneys that often. So the deeper you want to go, these guys can handle it.
All right. Well, I hesitate because these are things that honestly only get negotiated usually between attorneys. So I want to make sure I'm providing value, but yeah, with indemnification, it's usually about like you have something called a basket, which is like basically it's a deductible, like how much money do you just accept as a loss before you make a claim. So like
Yeah.
if there's a $500 damage, you just don't worry about it. The other thing is set off rights. So basically you're going to have the seller note and you're going to say, hey, I had an indemnification claim, I had some damage because a representation you said wasn't true. I need to just not pay you as much under the seller note. And they're going to say, well, that's fine, but only if, you fully adjudicate that claim against me. And then you say like, well, if I fully adjudicate the claim against you, I could just get the money from you directly. Why would I even care to offset it against the seller note? So that's another common thing. The other common thing is if there is a seller note, what's the security for the seller note? The issue there is a lot of sellers want the security to be the collateral of the company. The problem is that you're going to want to refinance your loan probably in a year and a half. And like, if you allow that to happen, then you probably would have to completely pay off the seller note as part of that refinancing. You probably don't want to do that because you want the seller to have some skin in the game. So like there's kind of some nuances. And again, this is like a good attorney will help you with all
So
that.
that's a good one. So how do you go around that part, that scenario where you have a seller? I'm assuming they're in the, they want to be in second position after the bank.
Yeah.
How do you negotiate that where they're not?
Well, what you can say is you say like, look, like I can maybe pledge the equity of the company. So that's not the same as the assets. And that means that if another, lender comes in and they want to secure the assets of the company, they can get a first lien on the assets of the company, even though the seller has a first lien on the equity of the company.
Oh, interesting.
So like that's a compromised position.
Got it.
So.
Okay. That's fascinating. What are some of the things that you get stuck on working capital at the end? Because that kind of gets, how much of it, by when, what have you seen in that small size, like below 5 million? What have you seen what works? Where are the compromises that work?
But sometimes something that happens is that you set a working capital target. You say there's got to be $100 of working capital. And the problem is that SBA does not allow for upwards adjustments. So let's say that there's actually $120 of working capital. Well, the seller will say, hey, there's $120 in working capital, so I should get, an extra $20. But that doesn't work with the SBA. Now, usually you just blame the SBA and the seller just kind of grumbles and they accept the fact that they're not going to get an upward adjustment. If the seller is being really, really, really like focused on this, what you can do is you can exclude some accounts receivable from the assets you're purchasing. And that will effectively get you into the same place. But you have to be careful about that because like they're going to want to exclude the accounts receivable that are the best accounts receivable that are going to be paid first. And you're going to want to exclude the accounts receivable that are going to be paid last. So, you know, there are workarounds and compromises, but you do have to be careful about it.
Got it. How about it, when you're dealing with other attorneys, what have you seen some of the, like, what's the sign that you're dealing with a good attorney on the other side versus not a great attorney on the other side?
Probably the biggest sign is how heavy the markup is. In general, the lighter the markup, the better the attorney. Although there are limits. There are some attorneys that like don't mark up anything at all. Like obviously that's not a good idea. But if they're like replacing whole sections, that means that you're dealing with a bad attorney. I never replace whole sections when I'm sell side. I will always work within the buyer's template because you want to limit the back and forth.
Yeah.
And the other thing is if they're just nasty, right? Like you can get on calls and you can just, some people just be nasty and like, that's just a sign. And so sometimes you will have to, if the seller's attorney is a nasty attorney, sometimes you just have to go directly and talk to the seller and be like, hey, but that's where you have to establish trust because the problem is that the seller's going to talk to the seller's attorney. The seller's attorney is going to be like, oh, the buyer's crazy and they're crazy and blah, 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 blah. And so like, there's a lot more tension there.
Yeah.
I mean, the best thing they can do is make sure they're dealing with somebody that actually does M&A, like this is their entire practice, and who's working on a flat fee, because when you're working on a flat fee, you have no incentive to like drag things out. Obviously, I'm biased because I do both those things. So.
No, I agree. I think that's what we preach here, like spending as much time with the seller up front as possible, building that deep connection, relationship where they're on your side, or on you both are on the same side, you know, to get this deal done as opposed to opposite sides and fighting the whole way. And you need that relationship, especially at the end when things get really, you know, confusing. And you get these it
gets very stressful and sometimes deals like it's funny so often like people will feel like the deal is falling apart and I as an attorney I'm just like, well, this is just a normal amount of like pre-closing jitters essentially. It feels like the end of the world, but often it's not.
Yeah. So what are the things that have you seen that kill deals at the end?
You know, honestly, it's rare for deals to die at the end. They almost always die at the beginning. And like your job is to kill it as close as possible to the end. There's some things I do see, honestly, decline in the performance. Biggest thing.
Decline performance of the business.
Yeah, they updated the financials and all of a sudden, and a lot of times it happens because like maybe the seller gets, you know, like distracted or maybe there's something wrong with the business.
Yeah.
You know? And then the seller's not willing to sell for the new price, you know, or whatever. That's probably the most common thing because everything besides that, you know, obviously lots of deals die in financial, but that, you know, if you're talking about things that truly die at the end, it's almost always performance.
How about legal due diligence? Explain what legal due diligence and then what usually pops in that process?
So usually what happens is we'll send a due diligence request list, then they'll upload stuff in the data room. You know, most of the time it's just confirmatory. Usually if there's an issue, we'll have already kind of spotted it at the LOI stage, right? Like we already know you have this key customer. We already know you have this key employee, whatever. And then we want to like front it and deal with it.
Yeah.
Right? But for everything else, usually just is more of a confirmatory process. We run lien searches, we run litigation searches, we make sure there's, you know, nothing in kind of the public record that indicates that there's an issue. You know, they're not exhaustive because running a litigation search in all 50 states like just is too expensive. But you run it in the state where they are. You try and see if there's any liens in the place where they are, and you know, but to answer your question, legal diligence is in 10% of deals extremely important, maybe 20% of deals, and in 80% of the deals, it's more of a check the box exercise.
Got it. Do you ever review the company contracts? Let's say the contracts they had with with their clients, or clients they have with their employees, or do you ever, or suppliers for that matter, see if there's any risk or any ticking bomb in there?
Yeah, I mean, we'll take a look at them. Most of the time, a lot of times agreements with customers are on the form, and you just look at the form and see, is there anything obviously wrong with it? And usually there's not. With suppliers, and a lot of times with customers too, a lot of times on a purchase order basis. So there's not really that much to do. Now, occasionally you will see like, hey, I've got a multi-year contract with a customer, and obviously we
Yeah.
scrutinize that.
Yeah, like I was thinking, for example, you have these, let's say landscaping company that do HOAs, and then they have, like a weird assignment clause, and you think you can assign, the contract is assignable, but it's not, or there's maybe a clause that you have to tell them when the ownership change, even though it's a stock sale, you still have to give them and tell them that the ownership has changed and they have a say. And so there are some like nuances that sometimes people assume it's one way, and then when you get to post acquisition, then it's a different way, and it becomes a problem.
Yeah, and I'd say those are mostly issues when you have like customers that are really hard to onboard. So think I'm selling stuff to not on Amazon, but to Amazon, or to like a Fortune 100 company, or to a university, and like
or government
vendor. Yeah, the government, exactly.
Yeah,
that's very much an issue. Even if contracts, say assignment, will be doing it, it's always good to reach out to all of them. Most of the time, if you're talking about like landscaping stuff, like a lot of times they're like, I want the work to keep going as it was done before, like as long as that's good, we're good. You know what I mean? But you're right, especially with large vendors, you have to be careful.
Yeah. And I mean, we had someone who's buying an architectural firm that does work for Apple, and Apple has this huge process, and they want to buy the firm because they were a vendor of Apple. So it's very hard to be a vendor of Apple. But now you have to go through their contract and find out, oh, can I actually keep the contract if it's a new ownership of this business? So that becomes
sometimes we've seen situations where they just assume the risk. Because the contract says you have to tell Apple and let them know, but like actually telling Apple about this will potentially have them like, anytime you tell like big customer something, there's some risk that they're gonna suddenly be like, oh, are we actually using these people? Do we actually like these people? Like, let's kick them from the team. So, that can be a business assessment. Just because a contract says something, you might deliberately choose to breach the contract because you think that the business risk is actually, higher doing what the contract says.
Yeah.
What if like it's a asset sale, and then your EIN changes, and like
then you
purchase
have
orders and things like that, you're gonna have to get them reset up.
Yeah.
Right. And that's one of the main reasons why some deals switch to being stock sales is because you have that issue.
Yeah.
Right. Because like if Apple had onboarded you as a vendor and you do an asset purchase agreement, you're absolutely right. There's no way to do it unless you re-onboard as the new person.
Yeah.
So,
Got it.
Yeah, it's a long process, and it's an arduous process. So that's why these guys choose to go stock sale. But then, you got to go into the nuances of that agreement. Any questions? Jamie, Miles, John, Jeremy?
One question real quick, and then is I sent my deal over to Craig, your SBA lender.
Nice.
Yeah. And he's just like, dude, you don't have to worry about QV for this. Like, the numbers are great. Like, don't waste your money. Is that something is that common?
What size of deal are you talking about?
$6 million purchase price.
That is the dumbest thing I've ever heard. Yeah, don't do QOV on a $6 million purchase price. No, that is
Okay.
just,
I would do it just to. So honestly, the way I think about it, it's not necessarily just to do the due diligence process. It's also for me to understand the business. And if you're working with a good financial due diligence person, you can also plan the transformation of that business post acquisition. So you can already see what can we do better? How can we restructure this better? Even if you just restructure the books or restructure your P&L and be able to see the numbers in a different way, in a different but yeah, I'm from the same. I want to do that due diligence. It's worth the money. Understand that business better.
the worst deal that we ever had was a deal where the buyer thought it was a smaller deal. The buyer thought he could get away without doing QOE because like the numbers were great and there was fraud.
Mhm.
And then the buyer it basically given like a bunch of money for something that was a fraud. So it can happen. So just I would say no. Don't do it.
I like the candid response.
Yeah, one deal I did, I had a buy side like broker, and what I kind of learned and didn't know anything about QV when I did it. I luckily had an accountant that pretty much did that, but the QV person in that process kind of did what my buy side broker helped with, right? So, and the QV was way less expensive than that buy side broker.
Yeah.
So I kind of justify QV moving forward for that reason now too.
Yeah. I mean, it really is just an essential part of the process. Like to give you a sense, we have declined representations in the past where the buyer has refused to do QOE because we see it as too much of a risk for us as a lawyer. I only get sued. Nobody sues me as a lawyer. Well, nobody sued me ever as a lawyer, but like nobody would hypothetically sue me because they bought a business that made them a millionaire, right? People sue because they bought a bad business. And like one of the best assurances to make sure you're not doing a bad business is that you're actually doing financial due diligence.
Yeah.
So like we would not represent people if they weren't doing QOE straight up.
And the banks also prefer, they feel much more comfortable. Your underwriting is much easier if there's a quality of earning report in place. So your underwrite, everything about your loan is going to get much faster, much better, much easier if there's a QOV in place.
Yeah, it's kind of like, well, the price of the home is so great, so just don't do a home inspection, like, but why? Like
Yeah.
home inspections aren't very expensive compared to the potential issues they would raise. Like, and it's part of the process of buying a home is doing a home inspection. Like, what are we doing here, guys? So,
Any other questions, guys? Covenants. What covenants do you see there? What interesting covenants do you see in purchase agreements? What have you seen? What are some of the wildest things you've seen in your purchase agreements or in negotiation over all the deals that you've done?
I mean, covenants usually relate to non-compete, right? Like that's the biggest thing, and like non-solicit is related to that. Confidentiality is fine. We also have like non-disparagement stuff, which is fine. Like that's rarely an issue. Sometimes people will get into like very specific stuff. Actually, one of the things, this isn't quite the same as covenants, but it's actually really important. As part of the closing, it's really, really, really good to get a list of all of the contact information, all the accounts that you need to log into stuff, the customer information, all that other stuff. Because like, I can tell you, like trying to get a seller who has just gotten several $1 million to like give you the login information so you can like make an update to your website, which has just crashed. Like,
Yeah.
it's just not a situation you want to be in. And so the other thing to front is like what's happening with the cell phone. A lot of sellers do business out of their personal cell phone, and they're like, don't want to give it up. So, have a plan for that, have a plan for personal email, just all these things you wouldn't think of, but once you've done enough deals, you realize like, oh my gosh, like this is a pain point that you didn't realize was a thing. But if you can't, if a bunch of calls are coming in from customers and nobody's answering because it's a personal cell phone, like that's a problem.
So do you just make it a requirement in your purchase agreement that's, we got to have the cell phone?
Yeah, that's our default. And we also tell them to have a conversation about it because like it's often at this level, it's often an issue. And you want to make sure, you just want to make sure that these things are figured out ahead of time. That is one of those things where if you don't talk about it ahead of time, it can be like a last minute drama at the end. Like, what do you mean you're taking my personal cell phone? So, best just to get out of the way.
So when the final question, what is the best deal you've ever seen, and what is the worst deal you've ever seen?
So the best deal we ever seen was one where they just had like a really compelling thesis, and we're not going to say what it was because it's still ongoing. And they've just been able to make lots and lots of money on it and really expand. So it wasn't really anything legal about it, but it was the right thesis, the right placement, and they're really just killing it.
What industry?
It was some type of I think it wasn't quite medical, but it was like medical adjacent, I think.
Okay.
But like it wasn't like a physician's practice or anything like that, but it was I think their customers were in that space. But yeah, worst deal we've seen is fraud. And I'll say this, the main things that will kill deals, number one, seller dishonesty, right? Fraud or the seller kind of getting back into the business afterwards or anything like that. That's the number one. Number two, working capital, not managing that properly. And then probably third is like employee and just those relationships. And number four is probably your sales ability, right? At the end of the day, these businesses most often run on sales. If you are not able to replace the sales function of the seller, then eventually you're going to die. But I would say number one, seller dishonesty. Number two, working capital. Those are the things that most commonly we see are problems.
Okay, makes sense. Pretty straightforward. All right. If no one has any questions, I appreciate it, Bill. Thank you for joining the call. This was really great.
All right.
Thank you.
Yeah, thank you.
We found it helpful.
Thanks,
Thank
Jay.
you.